Hello everyone, welcome to Atomic ACCA's pre-mock exam solving series, and in this video we are going to look at section A of Financial Reporting March 2025 exam. Now here we will have 15 questions to attempt. Each of it is 2 marks, so altogether 30 marks we have to score over here, and everything will be from different syllabus areas throughout our FR paper. Starting off with question number 1, which two of the following are not enhancing characteristics of financial information according to IASP's conceptual framework? Enhancing characteristics, we know that we have a mnemonic over here called as VCUT: verifiable, comparable, understandable, time bound, or timeliness. Now they're asking which is not an enhancing characteristic. Verifiable is an enhancing characteristic, so that is out. Materiality is not an enhancing characteristic, so that's one option. Comparable is enhancing characteristic, so that's not an option. Fourth one is relevance. So these two will be the options. Next one, what is the primary objective of IFRS S1 general requirement for disclosure of sustainability related financial information? Now, related to sustainability accounting, there's two accounting standards. IFRS S1 that talks about sustainability related risk and opportunities for the company. IFRS S2 is specifically about climate related disclosures. Now, keeping that in mind, let's do this. They're asking about IFRS S1 to mandate the entities to focus on short-term financial risk and opportunity. Wrong. Nothing about short-term focus is anywhere, enhanced or anywhere told to do so. No short-term, everything is about long-term focus only. So option 1 is out. To enhance the environmental conservation impact of entities by disclosing their efforts for climate action. That's related to IFRS S2. So that's out. To encourage short-term profit maximization of investors. Again, short-term focus, no focus. Don't even bother, just cancel out quickly, so that's also out. Last one, by elimination method, option D is the answer. To ensure that entities disclose information about sustainability related risk and opportunity useful for making decisions on providing resources to the entity. So as said, sustainability related risk and opportunity, but keep in mind not short term focusing, long term focusing. So we're done with question number 2. Question number 3, whenever we have any kind of numerical questions, always read the requirement first, get an idea from the requirement. Two things to focus always: number 1, what do they need; number 2, time period, what is the year end. So what will be the finance cost charged in SOPL? So this is the requirement. Next thing, year end 30th September 20x5 according to IFRS 9 financial instrument. So keep in mind 30th September x5 is our story ending. They need finance cost. So let's start this. On 1st October 20x4, so October to 30th September x5, so this is like a 1 year timeline. Fair deal issued loan note. Issuing a loan note means this is a financial liability. It has a nominal value of $1,000 each with a total value of 2.5 million. The issue cost were 3% of the nominal value and were paid upfront. Now we have under financial liability two accounting methods: amortized cost accounting and FVPL. Now here we have to figure out by the end of this question what accounting we have to follow, and based on that the numbers will work. Now the loan notes carried an interest rate of 6% per annum payable at the end of each year for 5 years. So 6% per annum, this is about the coupon rate. Loan notes are repayable at a premium, so the effective rate would be 10.84% per annum. Considering that nothing is mentioned over here and it is a repayable item and interest is payable annually, this is something that we have to follow based on the default accounting treatment, that is amortized cost accounting. As per amortized cost accounting, what is the initial recognition? Fair value minus any issue cost that is there, we will remove it, and whatever is pending, that will be the opening figure. Now question is asking what is the finance cost. So you have to multiply the effective interest rate on that opening balance in order to get the SOPL. So no need to calculate anything after that. Generally when it's an amortized cost question, most people start doing that entire format: opening plus EIR minus payment equals to closing. So no need to do the entire year thing. They're asking only for finance cost in SOPL. So we just need the second column figure, and that too for the first year itself. So things are quite easy. They just gave a blank over here about we have to put the answer over there. So they didn't tell round it off to a particular figure or write the whole number, nothing is there. So in such questions where complete blank is there, don't round off your figures when you're answering. Take whole number itself when calculating. For example, we have to calculate for 2.5 million. So the steps as we told were, we'll take 2.5 million. So don't write 2500 and do it. This is what we normally do when we round it off to the thousands figure. Considering it's only a blank we have, take the whole figure itself to avoid any mistakes. So 2.5 million, 2500 and 3 zeros. Okay, 2.5 million multiplied by 3 percentage is the norm issue cost. Now calculating what is 3 percentage, then minusing it out from 2.5 million is a lengthy method. Just be a little smart over here. If you minus out 3%, what's pending? 97 percentage. So 0.97 will be equal to 2425,000. So 2,425,000. Now this is the opening figure. On this amount, I need to calculate the effective interest rate to get the finance cost. So 2425,000 multiplied by 0.1084. 0.1084. That's 10.84 percentage. That is equal to 262870. So we'll write the full amount, 262870. 262870 is 262870. So that is the end to this particular question. Let's move to next one. Which of the following statements is correct in accordance with IAS 40 investment property? The investment property may be held as owner occupied property or a property held for sale in future. Owner occupied property is part of IAS 16, so this will not come out. An owned investment property shall be initially measured at fair value. No, it is initially measured at cost, purchase price. So that is also out. An investment property may be subsequently measured using cost model or fair value model, correct? Investment property must be depreciated regardless of whether an entity chooses cost model or fair value model for subsequent measurement. That is wrong. You can do depreciation only for cost model. In fair value model, there is no depreciation. So hope that one is clear. Now again, it's some numbers and also first read the requirement. Which of the following is correct accounting treatment for Alpha Company according to IAS 21 for the year ended 30th September X4? So year ending is 30th September and they're asking what is the correct accounting. So some random options are over here. So we'll have to figure out. Options are basically asking about some gain or loss and some payables and all. So hopefully the question is about payables, and payable we know is a monetary item. So you are supposed to convert it, I mean retranslate it at the closing rate. So opening rate, closing rate, see what is the gap, and that will be your gain or loss. So this is the whole story. Alpha Company uses dollar as its functional currency. On 20th August 20x4, it purchased goods worth Swiss franc 1.2 million when the exchange rate was 1 CHF is equal to $1.16. So we'll just note this down. This is question number 5. Okay, so 1.2 million. Okay, we'll just round it off. 1.2 million CHF is there. When the exchange rate was 1 CHF is equal to $1.16. So CHF and dollar, it's opposite currency. So we are supposed to multiply. So into 1.16. 1200 into 1200 into 1.16. Oops. 1200 into 1.16. That is equal to 1392. CHF and dollars, right? Swiss franc and dollar. Okay. So that is 1392 dollar. All right. Then they're telling on 20th September 20x4, Alpha Company paid 50% of the invoice amount. So 20th September, that payment date, some rate is given 1.14. That means 50% is paid means 600 CHF is cleared. And when multiplied with the rate on that date will be 1.14. That is equal to, okay, how do I clear this? Okay. 600 multiplied by 1.14. that is 684. So that is equal to dollar 684. Then according to the terms of contract, and the balance would be payable by 20th October 20x4. What is the year end? 30th September x4. So they're planning to clear it after the year end. Then Alpha Co has a year end of 30th September x4. Okay. And they've given the closing rate as well. Now what are we supposed to do? If 1200 was the opening, 600 is paid, then by the end of the year there will be 600 CHF pending in the payables amount. Now what is the closing rate? It's a monetary item, we have to convert it at the closing rate, so that is 1.17. So into 1.17 would be equal to 600 multiplied by 1.17, that is equal to 702. So 702 is the closing payable. Now trade payable 696, trade payable 702, 517, 512, trade payable 702. Okay, by doing half of it itself, we got what is the answer, because payable is 702 only in one case. So that is already found out. But let's see how the gain comes out. 1392 minus 684. 1392 minus 684, that is equal to 708 was supposed to be the payables, but by the year end it is only 702. So 708 minus 702, the payables went down by 6000. So that's why we have a net exchange gain of 6000 over here. So hope this particular question is also clear. Let's move to the next one. What will be the diluted EPS? So this is from IS 33 for Herald Company for the year ended 30th June X4. So this is our time period end. Okay, and they're asking amount up to 2 decimals. So be careful with this. Herald Company had 11 million shares in issue on 1st July X3. Year end is 30th June X4. So 1st July X3 means year beginning. 11 million shares were there in the beginning. Now, no shares were issued during the year on ended 30th June X4. Okay, there were outstanding 250,000 share options to be bought at $2.75 per share. Okay, so that is the discounted price. Nominal value per share is $1. That is like the base value. Whereas the fair value per share stood at 3.10 at 30th June X4. That is like the market value. Profit after tax is 5.2 million. Now the topic is related to diluted EPS and the calculations related to share options. Now we know question number 6. We know that for share option topic, the numerator will remain as it is, profit after tax. But when we do the denominator, we have to take the existing shares and we have to find something called as free shares. That is on conversion, how much this is. Now, profit after tax, we have it, where is it? 5.2 million. 5,200, 5.2 million, and divided by existing shares is 11 million. So 113030. Okay, so 11 million. And we have to now find out what is this free share calculation. How to find the free shares? We'll take the market value, that is 3.10 minus what is the discounted value, 2.75. So that is equal to 3.10 minus 2.75 equals to 0.35. 3.10, 2.75. Okay, 0.35 per share is the discount. Okay, now 0.35, how many shares are being given? 250,000 shares are being given. So 0.35 multiplied by 250,000 is equal to 87,500. So $87,500 is the total discount being given. Now, in the market, if they wanted to earn $87,500, how many shares they would have to give? Market price is 3.10, total value is 87,500. So if I wanted this much value from the market, 87,500 divided by 3.10 will be equal to 87,500 divided by 3.10 will be equal to 28,225.80645. This many shares I have to give. Now if I round it off, it will be 4645. If I round it off, this will be 81 basically. So 28,225.81. So 28,225.81. So what is this 28,225.81? This is the free shares. So I'll just replace this over here. It will become 28,225.81. Now 28,225.81 plus the existing 11 million shares. 11 30 3 more 0. So that is equal to 11. We'll just copy it over here so that we don't make a mistake. 110,282.25.81. Okay. What is the numerator? 520,000. No, that was 5.2 million, right? Profit. Okay. So 5,200. 3 more zeros and that one. So let's see if copy paste work in calculator. No, it doesn't work. So let's calculate 5,200 3 zeros divided by 110,282.25.81. The answer is equal to 0.471517,367. Now they wanted the diluted EPS rounded off to 2 decimals. So if I round off to 2 decimals, how much will it be? 0.47, and I have to see the next digit. What is the next digit? 1. When it is 5 or less than, when it's less than 5, you have to round it off to 0. So it will be 0.470, which is basically 0.47. Up to 2 decimals, so 0.47, and our answer is done. So this was our calculation for diluted EPS. Next one. Which of the following are adjusting events occurring after the end of the reporting period but before the financial statements are authorized for issue according to IAS 10? Now, announcement by the government about the revision in the tax rate that will affect the current tax liability. Announcement is happening post year end, so it's a new event, non-adjusting. A fraud discovered in the procurement department which happened before the reporting date. Fraud happened before, it was found out after. So there is an there is a thing that is existing at the year end which they found out post year end, so it's an adjusting event. So 2 will be correct. So in that case, it's either 2 and 4 or it's only 2. That means 3 is anyways out. So we can just read the fourth one. Loss of inventory caused by flood. Now, loss of inventory caused by flood. Now, flood is a new event that is happening post year end. It's nothing related to the previous year end. So that is anyways a new event. Fourth one is also out. So with that being said, 2 only will be our answer. Let's just read what is the third one. Destruction of a machine in the fire that may seriously affect the production capacity. Again, fire is a new thing that happened post year end. Nothing existed at the year reporting period. So again, that will not be considered. So it's only 2, that is the option over here. What would be the amount of borrowing cost to be capitalized? Amount of borrowing cost to be capitalized. So this is about IAS 23 in respect of the factory building according to IAS 23. Okay, all right. They didn't mention any year end and all, so be careful. Beta company began construction of its new factory building on 1st March X3. Okay. Cost of the construction was estimated at 1.5 million. Okay. Company borrowed 800,000. Keep in mind, 1.5 million is the total cost, but they borrowed 800,000 from the bank. That means your capitalization and whatever interest figure and all is there should be based on 800,000 bank figure and not the total cost of 1.5 million. So be careful with that. So they took the loan amount on 1st July X3. So even though construction began from 1st March, you don't have to bother. The money came into your hand only on 1st July X3. Now, at the interest rate of 6% per annum, all right. Construction was completed on 30th November X4. This is 1st March X3, 1st March X4, then 30th November. So, okay, that's like next year. Okay, it's like 1.5 years ahead, something like that. Okay, so more than 12 months timeline this is. Then Beta had temporarily invested 350,000 of the borrowed amount from 1st July X3. Witness 1st July X3. Okay, the date when you borrowed this to 31st December X3 at 4.5%. 31st December X3 means July X3, so that's like only July, August, September, October, November, December. Okay, that's only for 6 months. But loan will be there for comparatively longer period for more than 12 months because it is from 1st July X3 to 30th November X4. So this is the timeline. They're asking only about capitalized part, so you have to see only during the construction phase. Now, this is question number 8. Now, the loan interest figure will be equal to 1st July till 1st July X3 to 30th November X4. How long that is? July, August, September, October, November. 30th November X3, then till 30th November X4 there will be another 12 months. So 5 months over here, 12 months over there, that will be 17 months altogether. So I have to calculate 17 months of interest. How much loan did I take? 800,000 multiplied by, what is the interest rate? 6%, so 0.06, and 17 months, so 0.06 is per annum. So if I divide by 12, I'll get the monthly rate, and if I multiply this with 17, I'll get the 17 months interest rate. So that will be equal to 800 multiplied by 0.06 into 17 divided by 12, that is equal to 68,000. Then okay, there's a 68,000 option over here, but that is only based on what interest capitalized on the figure I borrowed. But the story doesn't end over there. I did some investment as well. How much was the investment? Investment was from 1st July X3 to 31st December X3. So as told, that was only for 6 months. So the amount is 350,000 multiplied by 0.045, that's 4.5 percentage, multiplied by 6 months over 12 months. So that will be equal to 350,000 multiplied by 0.05 multiplied by 6 divided by 12, that's equal to 7.875, equal to 7.875. So if I minus out 68,000 minus 7, it will be 61,000, and 0.875, it will be 60,000 something. Okay, so we have 60,000. We'll just confirm this. 68 minus 7.875, so that's 68 minus 7.875, 60.125. Okay, so we have our answer over here, 60,125. So we're done with that. Question number 9. What will be the finance cost for year ended 31st December X4 reflected in SOPL regarding the power plant? So this is 31st December X4 and they want finance cost. Okay. On 1st Jan X3, now that is year beginning, so this is like a 1-year timeline. KHS completed the construction and started using a power plant that has an estimated life of 25 years. Okay. According to the law of the country where KH is operating, it will be required to restore the plant and site at the end of the useful life. That's after 25 years. Estimated cost of dismantling and restoring after 25 years is 4 million. So that's like the future value. The cost of capital of KHS is 7%. Present value of $1 after 25 years is 0.184. Now why that is given? Whatever future decommissioning cost is there, we will multiply it with the discount factor. We will get today's value. What is today? Day 1 is 1st Jan X3. They want 31st December X4 finance cost. How is that to be calculated? The total amount is 4 million multiplied by the discount factor will be 0.184. That is equal to 736,000 is the opening figure. Now they want what is the finance cost for the year ended. This is not 1-year timeline, this is 2-year timeline. 1st Jan X3, 31st December X3, 31st December X4. So they want the second year finance cost. Now from the opening 1st Jan X3, how do I reach to 1st Jan X4? I have to jump by 7%. I have to inflate by this 7%. So what will I do? 736 into 1.07. So I will reach to 1st Jan X4. Now, I don't want to jump all the way to 31st December X4 because they're not asking what is the closing balance of that liability. They're asking what is the finance cost. So what will be the gap? The gap is 7% on the opening figure. So what is the opening figure for second year? 787.52. So 787.52 multiplied by 0.07, that's 7%, will be equal to 551264. So 551264, we have the answer over here. So we found out the solution for that. So this one is also done. Next, which of the following is correct regarding the initial recognition of investment in A Limited according to IAS 28 investment in associate? Initial recognition of investment based on IAS 28. So IAS 28 is equity accounting, and as per equity accounting you have to measure it at cost in the beginning. That is the purchase price basically. So on 1st July X4, okay, no year is given over here. Okay, so 1st July X4, P Limited acquired 30% shares in A company. So that's a significant influence. It's an associate. Acquisition agreement was such that if it gave P company significant influence but no control over A company. So that's understandable based on the 30% share. Now they're asking initial recognition, how you're supposed to do. Cost of acquisition of shares in A company. Okay, that seems fine. Let's see. Cost of acquisition plus profit of the associate. Now that is not right. Cost of acquisition plus parents share of profit or loss from associate is fine, but that too post acquisition period only. But again, that's not the initial recognition, that's subsequent recognition to get the closing balance. So option B is out. 30% of the fair value of net assets of A company, that is wrong. We don't take the net assets or the equity figure of the associate company and consolidate it, so that's wrong, out. Cost of shares acquired minus 30% of the cash balance of A company on the date of acquisition. There's nothing as such because cash balance, no assets, no liabilities, nothing is consolidated for an associate. So with that being said, B, C, D is wrong. So option A is your answer. You have to take only the purchase price of the acquisition and load it up as your initial investment. So that's done. Question number 11. Which of the following statements will be true for Trivi company? Okay, they're asking true statements. Okay. Current ratio of Trivi company is 0.9:1 as at 31st March X4. What is current ratio formula? Current assets by current liability. So this is indicating that 0.9 current asset is there and 1 liability is there, which means current liability is more than current assets in the company. First one, current assets are greater than current liability, false, because you can see current asset is only 0.9 and liability is 1. So that is out. Option, they're asking which one is true. Now 1 is false. So 1, this will not be the answer. 1 and 2 will not be the answer. Now we have to find out whether it is this one true or is both false. Okay. Company's liquidity position is in jeopardy. Jeopardy means basically in a risky position. So that is true because liabilities are greater than the assets. So it is in a little bit risky position for the company. That's not fine. Theoretically speaking, your current ratio should be at least 1.5 or 2 times. Your current asset should be greater than your current liability. So here your current assets is less. So your liquidity position is in a risky position. So second one is correct. So that is over. Classify each of the following items into appropriate category according to IAS 41 and IAS 16 by clicking on the relevant box in the table. Biological assets, bearer plant. Bearer plant, we know it's IAS 16. Biological asset, all these fruits and things and all, we know it's IAS 41. And harvested cotton. Until point of harvest, the thing is IAS 41. But post harvesting, it becomes your inventory in the company. So it is IAS 2. So these three are the options. So that is done. Without considering any adjustments other than the above, select which amounts will be reflected in the financial statements for Roxy company for reporting date of 31st March X3. Okay, what is reflected in financial statements for 31st March X3? All right. Profit before tax of Roxy company was 750,000 for year ended 31st March X3. Okay, same timeline. Profit before tax. All right. After charging depreciation on the building of $120,000. Okay, we'll just use Scratchpad for this. Question number 13 we're doing. Okay. Profit before taxes 750,000 and this is obtained after deducting depreciation of how much? 120,000. All right. The tax allowance for the building for year amounted to 150,000. Okay. So this depreciation is based on accounting depreciation, but in the tax books they are telling the tax books allowance is only 150,000. So what we will do is we'll take the profit before tax from the accounting books. So this is accounting books. Okay. This is accounting books. Accounting books has 750,000 profit before tax after deducting a 120,000 depreciation. So what we'll do, we'll reverse work it. Find out before this what should have been the profit in the accounting books. Then minus out the depreciation that is allowed within the tax books. That is 150,000. So here adjusted profit will be adjusted profit before tax would be equal to 750,000 is after deducting 120,000. So when I add it back, it will be 850,000, 870,000. So that will be equal to 870,000. Then I can minus out the tax depreciation. So tax depreciation allowance is how much? 150,000. So 150k. So in that case, the profit within the tax books, which is basically called as the taxable profit, that will be equal to 870 minus 150. How much is that? 870, 770, 720,000. So 720,000 is the taxable profit. So that is sorted now. Then they're telling tax rate is 30% on the taxable profit. Now there are two elements over here. You can see that income tax expense they want, that is SOPL item. Deferred tax liability they want. Current tax liability also they want. What are the options we have? They want figures from SOPL, SOFP to be chosen. SOPL, SOFP, SOPL, SOFP. Okay. So let's apply our knowledge and see what goes over here. First thing, the current tax, somewhere, where was it mentioned? Tax rate is 30% on the taxable profits. So what does this mean? That 30% should be calculated on the taxable profit in order to get what is the current tax expense. So current tax expense will be equal to 720,000 multiplied by 30 percentage. That is equal to 720,000 multiplied by 0.3. That is equal to 216,000. Now 260,000. For current year tax expense, what entries do we pass? We'll write debit expense within SOPL, credit liability within SOFP. That means related to current tax, there's an expense also that goes to SOPL and a liability that goes to SOFP. So with that being said, if we pass income tax expense, okay, we don't have 216,000 over here. Okay, we have to add deferred tax also. So let's keep that on hold. Current tax liability is how much? 216,000 that we have. SOPL 216, no, not this one. SOFP 216,000 because liability figure is in SOFP. So to confuse us, they have given SOPL also 216. So don't go fall for this. So SOFP 216. How about the deferred tax part? The difference between accounting profit and taxable profit, you can see there's a difference of 30,000 over here. Now you're accounting for 750,000, so bigger profit, bigger tax, but you end up paying only on 720,000 smaller tax. So what happens, based on the timing difference between what you have recorded in accounting books and tax books, you're accounting for big tax but you're paying small tax. Now is this a saving you have? No, you're paying small tax now, but later on you will pay higher taxes, which means this gap is leading to a deferred tax liability on you. That means your overall expense figure is going to go up. Now what is the difference? Deferred tax difference amount is basically 750 minus 720, that is equal to 30,000, and that difference multiplied by the 30% tax rate will be equal to 30 into 30% is straightforward 9,000. So this is a liability on you, which means your liability will increase, expense will increase. So you'll pass the entry debit expense credit liability for this one. So deferred tax liability within SOFP will be statement of SOPL 9, no, statement of SOFP 9000. Again, they've given that to confuse us. So statement of financial position 9000. What goes to income tax expense in SOPL altogether? 216,000 of current tax expense, 9,000 of deferred tax expense. That's a total of 216 plus 9 is equal to 225,000 SOPL. So we got our answer. So this one is done. 9 plus 16 is 225. Okay. So this question is over for IAS 12 taxation question. Let's move to next one. In accordance with IAS 38, which of the following costs should be capitalized? So you have to see which one meets the development criteria or whatever it is. But about capitalization. Number one, 1.1 million spent on researching a new material with the objective of reducing wastage. Given the title, it's researching a new material. It's in the research stage. So 1 is out, will not be capitalized. So 1 only will not be the answer. 1, 2 and 3 will not be the answer. So now I have to figure out whether 2 and 3 or is it only 2. So it's understandable that 2 is anyways an answer. Now I just have to figure out whether 3 is the answer or not. 850,000 spent on modifying a software that was internally developed 2 years ago. Now this is an internally developed asset. Internally generated brand value or any kind of intangible asset will not be recorded within your financial statement for individual company. So with that being said, 3 will not be the answer. But if the question was asking about consolidated financial statement, then this will be considered, because in consolidated financial statement, internally generated brand value, if you can assess a figure on that, will be considered and recorded within the financial statement. So here only 2 is the option, that is 1 million paid to acquire a patent that will have a useful life of 7 years. So patent it is with the definite life, so we are going to choose option 2 only. And last question, number 15 from section A. Identify whether each of the following statements are true or false in relation to an acquisition. P company acquired 80% subsidiary company on 1st October 20x3. 1st October is the acquisition date, 80%. Okay. P company paid an initial cash amount of 62 million and agreed to pay the owners of S company a further 26 million on 1st October x5. So that is like 1st October 20x3 and 20x5 is like 2 years later. Okay. 26 million should be considered when calculating goodwill on acquisition. Now, the statement seems a little wrong over here. You can interpret it this way. Let's say if they're talking simply about that figure should be considered within the goodwill calculation, true, you have to take the deferred consideration also within your calculation. But the statement is partially incorrect as well, because it is not 26 million that you have to consider for the goodwill calculation. It is the present value of 26 million that you have to consider. So if I interpret in that way, then statement is false. But if I interpret in the first way, that is whether the topic is deferred consideration is to be considered or not, yes, it is considered. But here they didn't mention the title deferred consideration, they mentioned the amount 26 million. So as said, just repeating, 26 million is not considered, present value of 26 million is considered. And considering that time gap is 2 years, that time value of money is also significant, so it's important. So with that being said, since you know both the interpretations and how answer could be, we can say it as a true also, we can say it as a false also. So for timing, let's go with any one, because we don't know what they are interpreting out of it, but I hope you understood the meaning of that sentence. Next one, when preparing the consolidated financial statements on 31st March X4, 20% of the profit or loss for the year should be attributed to NCI. Just look, I lost it. When preparing the consolidated financial statements on 31st March X4, 1st October X3 is acquisition, so October, November, December. No, wait, 1st October to 31st March X4. Okay, 31st March X4, that's 6 months. October, November, December, Jan, Feb, March. Okay, 6 months. Okay. While preparing consolidated financial statement of 31st March X4, 20% of the profit or loss for year should be attributed to NCI. No, not 20%, but 20% of the profit or loss multiplied by 6 by 12. only the post acquisition profit or loss should be considered, not the entire year's profit or loss, because as said, acquisition to date of reporting is only 6 months. So this one is false. So we're done with question number 15, and with that we are done with section A of this particular paper. Hope you have followed on how we have utilized the scratchpad and calculator alone in order to solve all of our questions. So with that being said, see you in the next video. Your first section B, question practice.